Let me tell you something that might change the way you think about retirement income forever. I have spent over 40 years managing money for some of the wealthiest families and institutions in the world. I have made billions of dollars. I have lost billions of dollars. I have learned lessons that most people will never have the opportunity to learn because they do not have access to the strategies and the thinking that goes on at the highest levels of finance. And what I am about to share with you today is something I wish someone had told me decades ago. Because if you are over 60 years old and you are worried about whether your money will last, whether you can generate enough income to live comfortably without constantly worrying about the stock market, then you need to pay very close attention to what I am about to say. Most people over 60 make a catastrophic mistake with their portfolios. They either take way too much risk chasing returns they do not need, or they hide in bonds and cash that barely keep up with inflation. Both approaches are wrong. Both approaches will leave you stressed, anxious, and potentially running out of money when you need it most. But there is a third way, a way that I have refined over decades of investing, a way that focuses on what actually matters when you are in or approaching retirement, which is reliable, growing income that shows up in your account like clockwork, regardless of what the market does on any given day. Today, I am going to share with you the exact 4-stock portfolio that I believe can generate guaranteed income for anyone over 60. Now let me be clear about what I mean by guaranteed. I do not mean guaranteed by the government or by some insurance company. I mean guaranteed by the underlying economics of these businesses. Businesses so essential, so dominant, so deeply embedded in the fabric of our economy that they will continue paying and growing their dividends through recessions, through market crashes, through whatever chaos the world throws at us. These are the businesses I would own if I had to live off the income and never touch the principal. Let me take you back to a moment that shaped how I think about income investing. It was 2008. The world was falling apart. Lehman Brothers had just collapsed. The stock market was in free fall. People were panicking. Portfolios were being decimated, and I watched as millions of retirees saw their life savings cut in half in a matter of months. But here's what I also observed. Certain stocks, certain businesses kept paying their dividends. Not only did they keep paying, some of them actually raised their dividends during the worst financial crisis since the Great Depression. While everyone was panicking, while the financial media was screaming about the end of capitalism, these companies quietly deposited dividend checks into shareholders' accounts, just like they always had. That experience taught me something profound about the difference between price and income. The price of a stock can do anything on any given day. It can drop 50% because of fear, because of panic, because of factors that have nothing to do with the underlying business. But the dividend, the actual cash that a company sends you, that is a reflection of real earnings, real cash flow, real business performance. And if you own the right businesses with durable competitive advantages and conservative financial policies, those dividends are about as close to guaranteed as you can get in the investment world. Now, I want to explain the framework I use to identify these income-generating machines, because not all dividend stocks are created equal. In fact, most dividend stocks are traps waiting to spring on unsuspecting investors. You see a high yield and you think you are getting a great deal. But that high yield often exists because the market is telling you the dividend is about to be cut. I have seen it happen hundreds of times. Someone buys a stock yielding 8% thinking they found a gold mine. 6 months later, the company slashes the dividend and stock drops another 40%. But they end up with less income and less principal. It is a disaster. So here is my framework for finding stocks that can actually deliver reliable income for decades. First, I look for businesses that sell essential products or services, things people need regardless of what is happening in the economy, things people will keep buying in recessions, in depressions, in wars, in pandemics. Essential businesses have pricing power. They can raise prices to keep up with inflation, and they generate consistent cash flow regardless of economic conditions. Second, I look for dominant market positions. I want companies that control their markets, companies with brands so powerful, distribution networks so extensive, switching costs so high that competitors cannot realistically take their customers. Dominance creates predictability, and predictability is what you need when you are depending on dividend income. Third, I look for conservative financial management, low debt, high free cash flow, management teams that prioritize returning capital to shareholders over empire building, companies that have raised their dividends for decades, not just years. This track record tells you that dividend growth is embedded in the corporate culture. Fourth, I look for reasonable valuations. Even the best company in the world is a bad investment. If you pay too much for it, when you overpay, your yield is too low and your potential for capital appreciation disappears. I want to buy great businesses at fair prices. When you apply these four filters, most stocks get eliminated. You are left with a small universe of truly exceptional businesses. And from that universe, I have selected 4 stocks that together form what I believe is the ideal income portfolio for anyone over 60. These 4 stocks provide diversification across different sectors, exposure to different economic drivers, and a combined yield that can support a comfortable retirement. More importantly, these 4 stocks have track records of dividend growth that span decades. They are not going to suddenly stop paying you because some Wall Street analyst downgrades them, or because there is a recession. Let me tell you about the first stock, and this one might surprise you because it is not typically thought of as an income stock, but it absolutely should be, especially for someone over 60 who wants reliable, growing income. The first stock is Johnson & Johnson. Now I know what some of you are thinking. Johnson & Johnson has been in the news for legal issues. There have been lawsuits and settlements and all sorts of negative headlines. But here is what I have learned over 40 years of investing. You have to separate the noise from the signal. The noise is the headlines, the lawsuits, the short-term drama. The signal is the underlying business fundamentals. And Johnson & Johnson's fundamentals are extraordinary. This is a company that has been raising its dividend for over 60 consecutive years. Think about that. 60 years. Through the inflation of the 1970s, through the savings and loan crisis, through the dot-com crash, through the 2008 financial crisis, through the pandemic, through every single economic challenge of the past 6 decades, Johnson & Johnson has raised its dividend every single year. That is not an accident. That is the result of owning a business that is absolutely essential to human health and well-being. Johnson & Johnson operates in 3 segments: pharmaceutical, medical devices, and consumer health. Actually, they recently spun off the consumer health division into a separate company called Kenvue. But the remaining business is even more focused on high-margin, essential healthcare products. The pharmaceutical business includes treatments for cancer, autoimmune diseases, infectious diseases, and mental health conditions. These are medications that people need to survive. They are not discretionary purchases. Nobody says, well, the economy is bad, so I am going to skip my cancer treatment this year. That does not happen. The medical devices business makes surgical equipment, orthopedic products, vision care products. Again, essential medical products that hospitals and doctors need regardless of economic conditions. The company generates enormous free cash flow, tens of billions of dollars every single year, and management has demonstrated over 6 decades that they are committed to returning that cash to shareholders through growing dividends. The current yield on Johnson & Johnson is around 3%, which might not sound spectacular. But here is what you need to understand about dividend growth investing. It is not about the starting yield. It is about the yield on cost over time. If Johnson & Johnson grows its dividend at 7% per year, which is roughly what it has done historically, your yield on cost doubles every 10 years. So that 3% yield becomes 6% in 10 years and 12% in 20 years. That is the magic of dividend growth investing. You are not just getting income today. You are getting income that grows faster than inflation for as long as you own the stock. The second stock in my 4-stock portfolio is Procter & Gamble, and this is another company with an unbelievable track record of dividend payments. Procter & Gamble has paid a dividend for over 130 years and has raised it for over 65 consecutive years. Let me say that again. 65 consecutive years of dividend increases. There is no company on earth with a longer track record of growing payments to shareholders. So what makes Procter & Gamble so special? The company owns some of the most powerful consumer brands in the world. Tide laundry detergent, Pampers diapers, Gillette razors, Crest toothpaste, Dawn dish soap, Charmin toilet paper, Bounty paper towels. These are products that people buy every single week regardless of what is happening in the economy or the stock market. When was the last time you stopped buying toilet paper because the stock market was down? Never. You kept buying it because you needed it. That is the beauty of consumer staples. These are essential products that generate incredibly predictable cash flows. Procter & Gamble has massive competitive advantages. First, their brands have been built over decades through billions of dollars in advertising and marketing. You cannot just launch a new toothpaste brand tomorrow and compete with Crest. The brand recognition, the trust, the shelf space in stores, it takes generations to build. Second, they have enormous scale advantages. Procter & Gamble can negotiate better deals with retailers, can spread their fixed costs over more units, can invest more in product development than any competitor. Third, they have global distribution. Their products are sold in virtually every country on Earth. That geographic diversification smooths out any regional economic weakness. The current dividend yield on Procter & Gamble is around 2.5%. Again, not a headline-grabbing yield, but combined with dividend growth of around 6% annually and the rock-solid safety of the business, this is exactly what you want in a retirement income portfolio. You will never lay awake at night wondering if Procter & Gamble will cut its dividend. It is not going to happen. They have survived world wars, depressions, recessions, and every other economic calamity of the past century, while continuing to raise their dividend. That is the kind of certainty you want when your retirement depends on it. The third stock is one that generates immediate income and has been a cornerstone of income portfolios for decades. It is AT&T. Now, before you say anything, I know AT&T has had a rough few years. They cut their dividend in 2022 when they spun off their media business. But here is why I still believe AT&T belongs in an income portfolio for people over 60. The company has stabilized. The dividend is now well covered by free cash flow, and the current yield is over 6%. In a world where 10-year Treasury bonds yield less than 5%, a 6% yield from a company with essential infrastructure is extremely attractive. Think about what AT&T actually owns and operates. They have one of the largest wireless networks in the United States. They have a massive fiber optic network providing internet and communication services to millions of homes and businesses. In the modern world, connectivity is not optional. It is essential. People need their phones, businesses need their internet. The data flowing through AT&T's networks grows exponentially every single year. Streaming video, remote work, cloud computing, artificial intelligence. All of these trends require more and more bandwidth. And AT&T is one of a handful of companies with the infrastructure to provide it. But the company has made mistakes in the past. The acquisition of Time Warner was a disaster that distracted management and loaded the company with debt. But they have divested those assets. They have paid down debt. They have refocused on their core connectivity business. And now they are generating enough free cash flow to comfortably cover the dividend while still investing in network improvements. The current payout ratio is around 50% of free cash flow, which is very conservative for a telecom company. That means there is a substantial cushion protecting the dividend, even if business conditions weaken temporarily, for someone over 60 who needs income today. Not income growth 10 years from now. AT&T serves an important role in the portfolio. That 6% yield means you are getting real cash flow immediately. If you invest $100,000 in AT&T, you are receiving $6,000 per year in dividend income. That is $500 per month hitting your account like clockwork. Combined with the dividend growth stocks like Johnson & Johnson and Procter & Gamble, you have both current income and future income growth. The fourth and final stock in my guaranteed income portfolio is Coca-Cola, and I include this one partly because of its extraordinary business qualities and partly because of what it represents about dividend investing. Coca-Cola has paid a dividend every year since 1920. Let that sink in. Over 100 years of uninterrupted dividends. They have increased the dividend for over 60 consecutive years. This company has survived the Great Depression, World War II, the Korean War, the Vietnam War, the stagflation of the 1970s, the savings and loan crisis, the dot-com bust, the financial crisis, and the pandemic. Through all of it, the dividend kept coming and kept growing. What makes Coca-Cola so resilient? The brand is one of the most recognized and valuable in the world. The Coca-Cola trademark is known in virtually every country on Earth, but more importantly, Coca-Cola has evolved beyond just selling soda. The company now owns a portfolio of over 200 beverage brands. Water, juice, tea, coffee, sports drinks, energy drinks. They have adapted to changing consumer preferences while maintaining the pricing power and distribution advantages that make them dominant. Coca-Cola's business model is also uniquely suited for generating reliable cash flow. They do not actually manufacture most of their products. They sell concentrated syrup to bottling partners who handle the capital-intensive production and distribution. Coca-Cola captures the high-margin, low-capital intensity part of the value chain. This asset-light model means they convert a huge percentage of revenue into free cash flow, and they can grow without massive reinvestment requirements. All that extra cash goes back to shareholders as dividends. The current yield on Coca-Cola is around 3%, and the dividend typically grows 5 to 6% annually. Combined with the other three stocks, Coca-Cola adds geographic diversification with its global operations, sector diversification as a consumer staples company, and an unmatched track record of dividend reliability. When you own Coca-Cola, you own a piece of one of the most successful consumer businesses ever created. Now let me show you how these four stocks work together as a portfolio. If you equally weight Johnson & Johnson, Procter & Gamble, AT&T, and Coca-Cola, your blended dividend yield is approximately 3.75%. On a $500,000 portfolio, that generates $18,750 per year in dividend income, or about $1,560 per month. That is real money that shows up in your account regardless of what the stock market does. But here is where it gets really interesting. Three of these four stocks, Johnson & Johnson, Procter & Gamble, and Coca-Cola, have histories of growing their dividends at 5 to 7% annually. Even if we assume conservative growth of 5% on those three, and no growth on AT&T, your portfolio income will roughly double over 15 years. That means the same portfolio that generates $18,000 today will generate $36,000 in 15 years. And that growth is passive. You do not have to do anything. You just hold the stocks and let the companies do what they have done for decades, which is grow their dividends. This is the fundamental advantage of dividend growth investing over other income strategies. With bonds, your income is fixed. A bond paying 4% today will still be paying 4% in 10 years and 20 years. Meanwhile, inflation has eroded your purchasing power. With dividend growth stocks, your income increases over time, usually faster than inflation. You are not just maintaining your standard of living, you are actually improving it every single year. Let me address something I know many of you are worried about. What happens when the market crashes? We all remember 2008. We all remember March of 2020. Stocks can fall 30, 40, 50% in a matter of months. Is it not risky to have your retirement income tied up in stocks? Here's how I think about it. First, remember the distinction between price and income. Yes, the price of these stocks will fluctuate, sometimes significantly, but the income, the dividends, will keep coming. In 2008 and 2009, the worst financial crisis since the Depression, all four of these companies maintained or increased their dividends. Investors who held these stocks kept receiving income throughout the crisis. They did not have to sell anything at depressed prices to pay their bills. They just collected their dividends and waited for the market to recover. Second, market crashes are actually opportunities if you are reinvesting dividends or have cash to deploy. When stock prices fall while dividends stay stable or grow, Your yield on new purchases increases dramatically. The people who bought more Johnson & Johnson and Procter & Gamble during the 2008 crisis locked in yields of 5 and 6% that will compound for the rest of their lives. Those shares bought at panic lows are now generating enormous income. Third, these are not speculative growth stocks that might never earn a profit. These are established, profitable, essential businesses that have operated successfully for over a century. Their stock prices might fluctuate, but their businesses will survive and thrive. The odds of Johnson & Johnson or Procter & Gamble going bankrupt are essentially zero. They are too essential, too profitable, too conservatively financed. So even if the stock price drops temporarily, it will eventually recover because the underlying business keeps generating cash. I want to talk about how to actually implement this strategy, because there are some practical considerations that matter. First, you need to think about position sizing. I have suggested equal weighting the 4 stocks, but you could also adjust based on your income needs. If you need more current income, you might overweight AT&T with its higher yield. If you have a longer time horizon, you might overweight Johnson & Johnson or Procter & Gamble for their superior dividend growth. Just make sure you maintain enough diversification that no single stock represents more than maybe 30 to 35% of your income portfolio. Second, you should reinvest dividends until you actually need the income. If you are 60 and still working, let those dividends buy more shares. The compounding effect is powerful. Each reinvested dividend buys more shares, which generate more dividends, which buy more shares. By the time you need the income at 65 or 70, your portfolio will be significantly larger than if you had been taking distributions all along. Third, you should hold these stocks in the most tax-efficient accounts available to you. Qualified dividends from U.S. corporations like these 4 stocks are taxed at preferential rates, currently 0, 15, or 20% depending on your total income. But if you can hold them in a Roth IRA, you pay 0 tax on the dividends and 0 tax on any gains when you sell. For traditional IRAs and 401k accounts, the tax is deferred until you withdraw. Consider your overall tax situation when deciding where to hold these positions. Fourth, resist the urge to tinker. This is probably the hardest part for most investors. When you own boring dividend stocks that just chug along paying their dividends year after year, it is tempting to sell them and chase something more exciting. Some hot tech stock or the latest market darling. Do not do it. The whole point of this strategy is consistency and reliability. Every time you trade, you incur transaction costs, potential taxes, and the risk of making a mistake. But the investors who have done best with dividend investing are the ones who simply bought great companies and held them forever. Let me share something about the psychology of income investing that I think is really important. When you build a portfolio focused on dividend income, it changes how you experience market volatility. Most investors watch the price of their portfolio and feel anxious when it declines. They start to panic. They consider selling. They make emotional decisions that hurt their long-term returns. But when you focus on income instead of price, the market's gyrations become much less stressful. As long as your dividends keep coming, and with these 4 stocks they will, the daily price fluctuations are just noise. I have talked to retirees who lived through the 2008 crisis holding dividend growth stocks. They told me they barely noticed the crash because their dividend income never changed. They were still getting the same deposits in their brokerage accounts every quarter. The only thing that changed was the number on their statement, and they knew that number was temporary. The psychological benefit is underrated. Retirement is supposed to be enjoyable. You are supposed to be relaxing, traveling, spending time with family, pursuing hobbies. You should not be glued to financial news worrying about your portfolio every day. A well-constructed income portfolio gives you freedom from that worry. Your income is secure. It will grow over time. You can focus on actually living your life instead of obsessing over the stock market. Now I want to address some objections I know some of you are thinking about. First, some people say dividend stocks are boring and underperform growth stocks. There is some truth to this in bull markets. When everything is going up, high-flying growth stocks often outperform steady dividend payers. But here is what matters for someone over 60. You are not trying to maximize total return anymore. You are trying to generate reliable income while preserving capital. A stock that goes up 50% in a year but pays no dividend does nothing for you if you need income. You would have to sell shares to generate cash, which reduces your future income potential. The dividend stocks might have lower total returns in some periods, but they provide the income you actually need. Second, some people worry about interest rates. When interest rates rise, income stocks often decline because investors can get higher yields from bonds. This is true in the short term, but over the long term, the dividend growth from these companies more than compensates for any interest rate headwinds. Bonds cannot grow their payments. These stocks can and do. Third, some people argue you should just use bond ladders or annuities for retirement income. These approaches have their place, but they also have significant drawbacks. Bonds provide fixed income that does not grow with inflation over a 20 or 30-year retirement. Inflation can devastate your purchasing power. Annuities often have high fees, limited liquidity, and no growth potential. Dividend growth stocks offer growing income, potential capital appreciation, and complete liquidity. You can sell anytime if you need to. You are not locked in. Let me summarize why I believe this 4-stock portfolio is ideal for anyone over 60 seeking guaranteed income. You have Johnson & Johnson, a healthcare giant that has raised its dividend for over 60 years, with essential products that people need regardless of economic conditions. You have Procter & Gamble, the king of consumer staples with over 65 years of consecutive dividend increases and brands that dominate their categories worldwide. You have AT&T providing immediate high-yield income from essential communications infrastructure that the modern world cannot function without. And you have Coca-Cola, 100 years of uninterrupted dividends from one of the most recognized brands on earth, with a uniquely profitable business model together. These 4 companies give you diversification across healthcare, consumer staples, telecommunications, and consumer discretionary. They give you a blended yield of nearly 4% today, with dividend growth that should exceed inflation for decades. They give you businesses that have survived every economic crisis of the past century and emerged stronger. And they give you the peace of mind that comes from knowing your income is as close to guaranteed as anything can be in the investment world. Let me dig deeper into something that most financial advisors will never tell you about retirement income planning. The traditional advice is to hold 60% stocks and 40% bonds, or some variation based on your age. The idea is that bonds provide safety and income while stocks provide growth. But this conventional wisdom was developed in an era when bonds yielded 6, 7, 8%. You could build a genuine income stream from high-quality bonds. Those days are gone. Even with interest rates higher than they were a few years ago, the yield on investment-grade corporate bonds barely keeps pace with inflation. And if you buy long-term bonds to lock in higher yields, you take enormous interest rate risk. We saw what happened in 2022 when the Federal Reserve raised rates aggressively. Long-term bond funds lost 15, 20, 25% of their value. So much for bonds being safe. The reality is that for most retirees today, dividend growth stocks are the only realistic way to generate sufficient income while maintaining purchasing power over a multi-decade retirement. Yes, stocks are more volatile than bonds in the short term, but they are actually safer over long periods because they can grow, they can adapt to inflation, they can increase their dividends while bond coupons are fixed forever. I want to walk you through a detailed example of how this 4-stock portfolio would have performed in recent decades. Let us say you retired in 2000 with $500,000 and put it equally into Johnson & Johnson, Procter & Gamble, AT&T, and Coca-Cola. In year 1, you would have received roughly $18,000 in dividends, or about 3.6% yield. Not spectacular, but solid. Over the next 25 years, through the dot-com crash, through 2008, through the pandemic, your dividend income would have grown substantially. Johnson & Johnson's dividend increased from about $1 per share to over $4.75. Procter & Gamble went from about 60 cents to around $4. Coca-Cola went from about 34 cents to nearly $2. Even AT&T, despite its challenges, maintained significant dividend payments. By 2025, that same portfolio would be generating roughly $50,000 per year in dividend income. Your income nearly tripled over 25 years, while the cost of living approximately doubled. You did not just keep up with inflation, you beat it. And you never had to sell a single share. You never had to worry about sequence of returns risk, which is the danger that early losses in retirement force you to sell stocks low and permanently impair your portfolio. You just collected dividends and lived your life. Now compare this to someone who followed the traditional advice and held mostly bonds. In 2000, they might have gotten similar income from a bond portfolio yielding around 6%, but that income never grew. By 2025, they are still receiving the same $30,000 they received 25 years ago, while the cost of everything has doubled. They have effectively taken a 50% pay cut in real terms. That is not retirement security. That is slow-motion financial ruin. This is why I am so passionate about dividend growth investing for retirees. It is not about beating the market or generating the highest possible returns. It is about creating a reliable, growing income stream that lets you live with dignity and security for as long as you live. And with medical advances extending lifespans, you need an investment strategy that can work for 30 or even 40 years. Only dividend growth stocks can realistically deliver that. Let me share some additional wisdom about constructing and managing your income portfolio. One critical mistake I see retirees make is chasing yield. They look at a stock yielding 8% and think it is better than a stock yielding 3%. But high yields are often warning signs. They frequently indicate that the market believes the dividend will be cut. I have seen this pattern repeat dozens of times in my career. An investor buys a high-yield stock. The company cuts the dividend, the stock crashes, and the investor is left with less income and less capital than if they had just bought a lower-yielding but safer stock. The 4 stocks I have recommended all have moderate yields, between 2.5% and 6%. These yields are sustainable. They are backed by strong free cash flow. They can be maintained and grown for decades. That is far more valuable than a high yield that might disappear next quarter. Another mistake is over-diversification. Some people think they need 20 or 30 dividend stocks to be properly diversified. But with more stocks comes more complexity, more research requirements, more opportunities to make mistakes. 4 carefully selected stocks in different sectors provides excellent diversification for an income portfolio. You do not need more. In fact, adding more often just dilutes the quality of your holdings by forcing you to include second-tier companies. I also want to address the question of when to buy. Many investors try to time their purchases, waiting for the perfect entry point. This is usually counterproductive. Time in the market beats timing the market. As they say, if you have money to invest for income, the best time to buy is now. Yes, you might get a better price if you wait for a market pullback. But you also miss out on dividends while you wait. And the pullback might never come, or it might come from levels far higher than today. The dividends you collect while waiting for the perfect entry point are guaranteed. The lower prices you hope for are not. That said, there is nothing wrong with dollar cost averaging into your positions over several months. If you are investing a large sum and want to reduce the risk of buying at a temporary peak, divide your purchase into quarterly or monthly amounts and buy regardless of what the market is doing. This smooths out your entry price and removes the emotional component from your investment decisions. Let me talk about what to do with your dividends as your situation evolves. If you are in your early 60s and still working, reinvest every dividend. Let the compounding work for you. Each reinvested dividend buys more shares, which generate more dividends. This snowball effect is incredibly powerful over time. If you reinvest dividends for even 5 years before you need the income, you will have meaningfully more shares and meaningfully more income when you start taking distributions. Once you retire and need the income, switch to receiving your dividends in cash. Most brokerages make this easy to configure. You can have dividends deposited directly into your checking account or held in your brokerage money market fund. Time your distributions to match your expense needs. Many retirees find that quarterly dividends align well with quarterly expenses like property taxes, insurance premiums, and estimated tax payments. As you age, you might also consider gradually shifting your portfolio toward higher current yield and away from dividend growth. In your 60s, you have a long time horizon and can afford to emphasize growth. By your 80s, maximum current income might be more important. You could gradually increase your allocation to ATE&T or similar higher yielding stocks while reducing holdings in lower yielding growth names. But do not make drastic changes. The beauty of this portfolio is that it works for decades with minimal intervention. I want to spend some time discussing the tax advantages of qualified dividend income, because this is something many retirees overlook. Qualified dividends, which include dividends from U.S. corporations held for more than 60 days, are taxed at preferential rates. If your total taxable income is below roughly $95,000 for a married couple filing jointly, your qualified dividends are taxed at 0%. It is right, 0 if your income is higher, you pay either 15 or 20%, still much lower than ordinary income tax rates that can reach 37%. This favorable tax treatment significantly increases the after-tax value of dividend income compared to interest income from bonds, which is taxed at ordinary rates. A 4% dividend yield taxed at 0% gives you 4% after tax. A 4% bond yield taxed at 22% gives you only 3.12% after tax. That is a huge difference over a multi-decade retirement. To maximize this tax advantage, consider doing Roth conversions in years when your income is low. Moving money from traditional IRAs to Roth IRAs allows future dividends to be completely tax-free. Yes, you pay tax on the conversion amount, but if you can convert during low-income years and then let the dividends compound tax-free for decades, the long-term benefit is enormous. Also consider the optimal account location for your dividend stocks. In taxable accounts, you get the preferential qualified dividend rates. In traditional IRAs, dividends are tax-deferred, but eventually taxed at ordinary rates when withdrawn. In Roth IRAs, dividends are completely tax-free. Generally, it makes sense to hold dividend growth stocks in Roth accounts if possible, since the growing dividends will never be taxed. If you must choose between taxable and traditional IRA accounts, taxable might actually be better for dividend stocks due to the preferential rates on qualified dividends. I have spent my career managing money at the highest levels. I have access to strategies and investments that most people will never see. And yet, if you asked me how I would invest for retirement income, this is exactly what I would tell you. 4 great businesses. 4 growing dividends. 4 pillars of financial security. That is the formula for guaranteed income in retirement. It is not complicated, it is not exciting, but it works. And at the end of the day, that is all that matters. Your retirement is not a game. It is not a place to take unnecessary risks or chase the latest hot investment. It is your life savings. The money you need to live with dignity and security for the rest of your life. Treat it with the respect it deserves. Build a portfolio of essential dividend-growing businesses. Collect your income and enjoy your retirement, knowing your financial future is secure.